Hey there, Austin. It's Chris. Hope you are doing well. Hope the jet lag is worn off from Costa Rica. Wanted to share with you options, adjustable rate mortgages versus 30-year fixed. Bottom line, if you've only got 60 seconds to watch this video, adjustable rate mortgages are not very competitive on investment properties right now. Full stop right there. You don't have to watch anywhere else if you don't want to. Now, to dive into the numbers, a 30-year fixed today, here are the options. So these are our two options for a 30-year fixed. 20% down, the rate would be 5.875%. 25% down, 5.375%. So you improve the rate by 0.5% by increasing your down payment. Now, I will say that these are rates from the lender that we are conditionally approved with. We're not married to that lender. I can certainly shop around to see if I can find a lower rate, but that was the natural starting thought for me. Now, adjustable rate mortgages, as I said, they're lower. It's 5% with that I'm quoting you. However, when you click on more info, and I'll send you a link to this tab, you notice you've got to pay a king's ransom to get that. 20% down, you're paying almost $16,000 in points, almost or over $12,000 in points for 25% down. I would never advise someone to pay that many points on an adjustable rate mortgage when you're looking at possibly only having the loan for 1, 2, maybe 3 years. I mean, these rates are 7-year ARMs, so they're fixed for 7 years. But there's going to be an opportunity in the next, let's say, 24 months where rates are going to dip, because we are probably 6 months to 12 months away from a recession. Do I think it's going to be a bad one? Who knows? I personally don't think it's going to be a bad one. I think it's going to be bad enough to where the Fed is going to need to lower short-term rates, because we're going to see, I don't know if we're going to see negative growth. We're going to see much slower growth. Maybe we do see negative growth. I mean, the definition of a recession is negative growth, but I'm not certain that we're going to see a prolonged bad recession. However, I think the Fed is smart right now to raise short-term rates at the rate that they're doing it in order to be in a position to drop rates, because I think that the economy is showing signs of slowing down. That said, my advice here is we look at interest rates. Yes, they are in the 5s. Yes, they are high, but we look at a rate where you're not paying a ton of money out of pocket right now, because there will be an opportunity to refinance lower in the next 1 to 2 years. And while we've never said this, I can expect and think that your goal with this house is to buy and hold for the long term. So having a rate in the 5s now, whether it's for 1, 2, or 3 years, is short-term pain for the opportunity to refinance to the 4s, high 4s, maybe even low 4s. I personally think that we are probably just as quickly as we went up to 5%. I mean, gosh, April was a rough month. I feel like we skipped 4%. Or any version of 4% that month, and went straight from high 3s to low 5s during the month of April. That rapid climb up, I think we're going to see a similar gradual decline in the second half of this year, fourth quarter, or even first or second quarter next year, where we see rates chop down gradually over time to where we're in the low 4s on an investment mortgage. Sorry, a rental property mortgage. So that being said, I'll send you a link to this video. I will send you a link to this report. The main takeaway here is that the most expensive option is a 30-year fixed with 20% down. The sweet spot, 30-year fixed, 25% down, is $346 less expensive every month. And as you can see, over a 15-year period, it is the least expensive option in terms of interest, assuming the adjustable rate mortgages do increase to the worst case scenario after the fixed period is over. So we don't need to make any decisions about rates right now, but we can certainly just have have multiple options in our wheelhouse. Thanks, Austin.